Hi guys, welcome back to the channel. My name is Dave, and last week we started talking about getting offensive in a bear market. So one of the things I mentioned was covered puts. It's not talked about very often, but people get dragged in to options through something called the covered call. It's ever so popular, right? It's the Gronkowski of options. Everybody knows Gronkowski and covered calls when it comes to options, but Gronkowski has a twin that nobody talks about. They keep it over there in the corner, and that's the covered put. And I picked Sloth. I mean, look, Sloth, Gronkowski, they kind of look like they could be twins, distant cousins, but they're both good. One we just don't talk about. So today we're going to talk about what we don't talk about, and that's the covered put. If that is what you're looking for, please stick around. Whoop. All right, so first let's talk about covered calls. Let's get this out of the way so we understand it. And I'll link some videos as well if you're not real familiar with this information. But the perfect covered call, right? Let's say it's stock XYZ, always trading at $100 per share, and we go out and we buy 100 shares. That means we spend $10,000 to get those 100 shares in our account. Then we go out and we sell the 105 call option, right? We write out an option, the 105 strike price, out about a month. We do that because we want to collect a premium. So let's say we collect $200 for that and we put that in our pocket right now and we're off to the races. Now the perfect scenario, what we really want to have happen is we want to have the stock head right towards that strike price. We want it to go right to 104.99, right? And then expire because that gives us control of everything, right? We still control the shares, we got our premium, and we got the stock appreciation from 100 to 105. That is the perfect covered call. That's what we really want to have happen. Now, as someone gets, let's say, older in age and they're looking for income, one of the reasons people like these covered calls is, I would say, is it takes the edge off. It's like a great shot of whiskey, right? Because we do limit our profit potential because we don't get anything above 105. I mean, we get the premium that we collected plus that stock appreciation, but we don't get anything beyond that. So if it goes to 110, 115, we're limiting our profit potential. But we're also protecting our pot of money that we've been accumulating because if, let's say, the stock goes down to 97, we lose $300 from it going from 100 to 97, but we still keep our $200 of premium. So as an investor trying to protect our pot of money, our basis has been reduced to 98, so we only lost $100. So that's the scenario for covered calls and why people like this strategy. And I think why a lot of people gravitate towards this that are driven towards generating income off their pile of money. So let's talk covered put. So it's exactly like a covered call, but it's in the opposite direction. So last week I said a covered call, but it's like Stranger Things where you're in the upside down. So everything is the opposite. So instead of buying 100 shares of stock XYZ at 100, you're going to short sell 100 shares of stock XYZ at 100. So it's pegged at 100. In your account, it's going to say minus 100 if you're not familiar with short selling. But will be negative 100. It's like an IOU, 100 shares at a later date. I've already sold them. I'm going to have to buy them back in the future. So my bet is that it's going to be going down. I want to buy it at a lower price because I already sold it at a higher price. Simple enough. And we'll talk more about short selling as we go through this. But that's step one. Step two is really simple. You're going to sell a put, right? We're going to write out a put option. We're going to sell it at a lower strike price. That's the general setup. So we're going to say, I would like to sell to open one put contract at $90 strike price out about a month, and I'm going to collect my premium. I put my $100 in my pocket, and time goes by. That's the setup. So our goal here is just like the covered call, but instead of in the positive direction, we're going in the negative direction. So we want, in a perfect scenario, for this thing to go right towards $90 a share and expire. If it expires right at 90, again, we can buy it back at that point at 90, and we've already sold it at 100, so we get 10 points there plus the premium that we collected. Now, if it goes flying past that, goes to 85 or 80, even goes lower, right? We will take assignment and we'll be made whole again, right? Because at that point, they're going to say, ha, I got to put 100 shares to you. And you're like, great, okay, we did okay on this trade. It went lower. We limited our profit potential by selling that put, but we still did well in the trade overall. So at this point, we would take assignment and we would receive 100 shares. We had minus 100. We're back to even. Everything is perfect in the world. We just did our covered put. So obviously another situation that can and probably will occur at some point with a short position like this is that the stock takes off, right? Now we collected a $100 premium in this case on a stock that was at 100. So if it goes up to 101, that's our break even, right? We could get out at that point and we would be even. But if it goes to 110, 120, 130, well, now we're in a little bit of trouble, right? We're going to start losing a lot of money in this case. And you can actually lose more than your initial investment which is not true when you buy stock, right? If you buy a stock and you pay $2,000 for it, it goes to zero, you can only lose $2,000. But with a short position, it continue to go up, you can lose more than your initial investment. For example, I have a short right now in Palantir. Not a big fan. It was all the way up to 20 bucks earlier in the year, and now it's at about 7. I've got a short position, and I've been selling covered puts against it. Doing all right. But if it was to go back to its old value of 20, right? Let's say you bought 100 shares and you spent 700 bucks right now. It goes all the way back to 20 bucks a share. That means it's worth 2,000 now. So when you would close out that short position, you would have lost 2,000 minus 700. You lost $1,300, right? So you can lose a lot more than your initial investment. That's really important to understand in a short position. So for that reason, if you're concerned about the stock taking off, you can put a collar on it, just like you would with a covered call like NUSI does. We've talked about this before. But in this case, it makes a little bit more sense, right? Because we're worried that Elon Musk comes through and buys Palantir and the thing takes off, it triples in value. So how do we protect ourselves? Well, we take the premium that we earned, that 100 bucks, we take 20% of it, 20 bucks, we buy an out of the money call to protect ourselves from this thing taking off. It doesn't cost that much, but it gives us a little bit of security in case something disastrous happens during the time that we're in this particular trade. So it's one way to go about it to reduce the risk overall. Now, if this is SPY, then don't do it. But if it's some no-name stock I've never heard of, then you might consider it. And one other consideration has to do with dividends. So if you're in a short position and you're not familiar with this, when a dividend is paid, you have to pay it to the shareholder, right? It's going to get taken out of your account and paid to someone else. Now, there's a yin and yang to this. So if you're not used to it, right, it might look a little strange that you're paying it out. But it's also going to drive the stock price down because it's going to be corrected for the amount of that dividend that is paid out. So it benefits you in the sense that you're in a short position, whereas it stings because they're taking money out of your account. So it is offset by that. But just be aware, if you're not used to seeing that, that could happen if you carry this through an ex-dividend date. Now, I will link my video from last week that I did about getting offensive in a bear market. So my personal view, getting into 2023, is that we're going to see a down period here for Q1, Q2. And I'm going to set my portfolio up that way to take advantage of it. Hopefully, that's my viewpoint. We'll see if it comes to fruition. But I went from owning 200 shares of SPY to actually being short 200 shares, as you can see in my account here. I'll show you my current setup that I got going this week. I'm also selling some naked calls, so I might go shorter. Here might be short 300, 400, 500 shares before you know it. So SPY. So my cost basis right now is $400.57. You can see that. So with it already dropping this week down to $393.28, and I do think the market might still have legs going into the rest of December. Powell's coming out next week and talking. That could bolster the market for another week or two. We'll see, but I think my long view here, Q1, Q2, we're going to see a correction. So that's what I'm setting up for. So you can see, so far I'm doing pretty good. I'm up $1,400 on these 200 shares that I'm short. And I did sell a $390 put out for January 6th, early next year, and I collected $541. Again, putting that in my pocket, reducing my basis overall, and setting myself up. So right now you can see that that's the current value is negative 46%. So I've lost on the option itself, but I think that I'm okay with it. Like if it goes down below, I'm okay losing 100 shares. I'm going to continue to follow if it continues to go lower. So that's kind of my setup, and that's how it'll look like. So minus 200 shares in my account, it shows my short position, and it shows my SPY 390 put that I'm setting up for that first one. If we go a little bit lower on Monday, I'll probably sell another call at a lower strike, setting up for Jerome to come out and talk to us. So that's the setup, and that's what it'll look like. So that's just an introduction to the covered put, the one that always gets ignored, the ugly twin. It sits over there in the corner where everybody talks about the covered call, but just as useful, so don't ignore it. At the right time, it can be great. One more thing to have in the war chest. Now, if you like this type of content, please like and subscribe. If you have any questions at all, just ask down below. I'll be sure to get back to you. Now, thanks so much for watching. Have a great weekend. We'll see you.